What if I told you that losing money in the stock market could actually save you thousands in taxes? Sounds crazy, right? But there's a perfectly legal IRS strategy that lets you turn investment losses into tax deductions. It's called tax loss harvesting, and wealthy investors use it all the time. The best part? You don't need to be rich to use it. In the following video, I'm going to show you exactly how it works and how you can use it yourself. Let's break it down. Welcome back to KP Money Talks. And if you're serious about keeping more of what you earn, you're in the right place. Today, we're diving into tax loss harvesting, one of the smartest tax strategies investors use to reduce their tax bills while staying fully invested in the market. If this helps you, hit that subscribe button and turn on notifications. We release content every week on personal finance, investing, and tax strategies that actually work. Let's get into it. Tax loss harvesting is the strategy of selling investments at a loss to offset capital gains and reduce your taxable income. Here's the basic concept. When you sell an investment for more than you paid, you realize the capital gain, and you owe taxes on that profit. But when you sell an investment for less than what you paid, you realize a capital loss. The IRS lets you use these losses to offset your gains dollar for dollar, and if your losses exceed your gains, you can deduct up to $3,000 against your ordinary income each year. Here's a simple example. Let's say you bought stock A for $10,000 and sold it later for $15,000. That's a $5,000 capital gain, and you'd normally owe taxes on it, about $750 to $1,000 depending on your tax bracket. But you also bought stock B for $8,000, and now it's worth $5,000. You're sitting on $3,000 lost. If you sell stock B before the end of the year, you lock in that $3,000 lost. Now your $5,000 gain minus your $3,000 loss equals $2,000 in net gains. You only pay taxes on $2,000 instead of $5,000. That's tax loss harvesting in action. You're strategically realizing losses to reduce your tax bill. The beautiful part is that you can harvest these losses, reduce your taxes, and then immediately buy a similar investment to maintain your market exposure. You're not giving up on the stock market, you're just tax efficient about it. Now here's a catch you absolutely need to understand: the wash sale rule. The IRS isn't going to let you sell a stock at a loss, claim the tax deduction, and then immediately buy it back the next day. That would be too easy. Now you might be wondering, what is the wash sale rule? If you sell a security at a loss and buy back the same security or something substantially identical within 30 days before or after the sale, the IRS disallows your loss. Let me repeat that. It's 30 days before and 30 days after. That's a 61-day window total. So if you sell Apple stock at a loss on December 15th, you cannot buy Apple stock back until January 15th or later. Now you might be wondering how to work around it. Here's where it gets smart. You can maintain your market exposure by buying a similar but not identical investment. You can go about it through 4 different strategies. Strategy 1. Switch providers. Sell an S&P 500 index fund from Vanguard and immediately buy an S&P 500 fund from Fidelity or iShares. They track the same index, but the IRS considers them different securities because they're different funds. Strategy 2. Switch similar stocks. Sell Microsoft and buy Google. Both are tech giants, but they're substantially not identical. You stay invested in big tech, but you have harvested your loss. Strategy 3. Buy an ETF instead of individual stock. Sell an individual tech stock and buy a tech sector ETF. You maintain tech exposure, but avoid the wash sale rule. Strategy 4. Wait 31 days. Just wait out the 30-day period and buy back the exact same investment. You'll be out of the market temporarily, but your tax loss is preserved. The key is planning ahead. Don't accidentally trigger the wash sale rule and lose your tax benefit. Tax loss harvesting isn't for everyone, and it's not useful in every situation. Let's talk about who benefits most. This strategy works best for high-income earners. If you're in the 24%, 32%, or higher tax brackets, saving on capital gain taxes is more valuable. Long-term capital gains are taxed at 0%, 15%, or 20% depending on income, so higher earners pay more. People with taxable brokerage accounts. This is critical. Tax loss harvesting only works in regular taxable investment accounts. You cannot use it in an IRA, 401k, or other retirement accounts because these are already tax advantaged. Investors with realized gains. If you sold stock for a profit earlier in the year, harvesting losses before year end can offset those gains. Long-term investors. This works best for people who are rebalancing anyway or have genuinely changed their mind about an investment, not people trying to time the market. Now, if we talk about when to harvest losses, you can harvest losses anytime during the year, but most people focus on November and December because you can see your total gains and losses for the year. You have time to strategically offset gains. It's your last chance before the December 31st cutoff. However, smart investors review their portfolios quarterly. If you have big losses in March, don't wait until December. Harvest them and use them strategically. Here's a powerful feature. If your losses are bigger than your gains, you can deduct up to $3,000 of those losses against your ordinary income, your salary, freelance income, whatever. And any losses beyond that, they carry forward indefinitely to future years. You don't lose them. For example, you have $10,000 in losses and $2,000 in gains this year. You offset the $2,000 in gains, deduct $3,000 against ordinary income, and carry forward $5,000 to next year. That $5,000 carry forward and can offset gains or income in future years. It never expires. Alright, let's talk about how to actually do this. Step 1. Review your portfolio. Log into your brokerage account and look at your positions. Identify investments that are in the red, worth less than what you paid for them. Your brokerage should show you the cost basis versus the current value. The difference is your unrealized loss. Step 2. Calculate your tax situation. Before you sell anything, understand your tax picture for the year. Do you have realized capital gains for the other sales? Are you in a high tax bracket where the savings matter? Will you benefit from deduction? Step 3. Decide what to sell. Don't sell a great investment just for tax loss. Only harvest losses when you're rebalancing your portfolio anyway, you have genuinely changed your investment thesis, the tax benefit makes strategic sense. Step 4. Execute the sale. Sell the position that's at a loss. Make sure the trade settles before December 31st if you want the loss for this tax year. Most stocks settle in 2 business days. Step 5. Reinvest strategically. Immediately buy a similar but not identical investment to maintain market exposure, or wait 31 days and buy back the original investment. Don't sit in cash. Time in the market beats timing the market. And finally, step 6. Document everything. Keep records of the date you sold, the amount of the loss, what you bought as a replacement, when you repurchased, if you did. Your brokerage will send you tax forms, but having your own records help. Consider automated services. Some robo-advisors like Betterment, Wealthfront, and Schwab Intelligent Portfolios offer automatic tax loss harvesting. They monitor your portfolio daily and harvest losses automatically while avoiding wash sales. If you have a large portfolio and want to maximize tax efficiency, these services can be worth it. Let's wrap this up. Tax loss harvesting is selling investment at a loss to offset capital gains and reduce your tax bill. Here's the key points. Offset gains dollar for dollar with losses. Deduct up to $3,000 against ordinary income. Carry forward excess losses for future years. Watch out for the wash sale rules. 30 days before and after. Only work in taxable accounts, not retirement accounts. Don't sell great investments just for the tax losses. If this helped you understand tax loss harvesting, smash that like button and subscribe for more tax and investment strategies. Drop a comment below, and thank you for watching. I'll see you in the next one.